Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week, we're covering the top 10 things to know about filing Form 540 for 2025. Spidell's federal and California tax update will get you fully prepared for the coming tax season. You can register for an in-person seminar or a live webinar at spidell.com. With filing season right around the corner, tax professionals need to stay on top of the biggest adjustments and filing tips that they'll need to correctly file their clients' Forms 540. Between OBBBA, California's big conformity bill, and the Los Angeles wildfires, there's a lot to stay on top of. Here's a list of the top 10 things to know for filing 2025 California returns. Number 1, Los Angeles wildfires have to be noted on the 2025 tax return by following tax software prompts or writing LA County wildfires at the top of the return in order to avoid estimated tax underpayment penalty notices. Although the 1st through 3rd 2025 estimated tax payments were all postponed until October 15th, underpayment penalty notices will automatically be sent if the disaster is not indicated on the 2025 return. And we know that notices may still be sent out to some taxpayers, but this will minimize the chances. Number 2, alimony payments are still deductible on the 2025 return and reportable by payees. California's conformity to federal treatment of alimony deductions only applies to divorce or separation agreements entered into after 2025. Number 3, California's wildfire settlement exclusion amounts may differ from the wildfire disaster relief payment exclusion allowed on the federal return. The California exclusion applies to both business and individual losses, whereas the federal exclusion only applies to individual losses. Also, the California exclusion is not limited if losses, expenses, or damages were otherwise covered, like through insurance. Number 4, personal income taxpayers and partnerships subject to the business interest expense limitation on their federal return should consider extending their 2025 California return. Due to a drafting error, California inadvertently conformed to IRC 163 subsection J for personal income taxpayers, but not corporate taxpayers. This should be fixed retroactively with legislation in 2026, but until this legislation is enacted, personal income taxpayers will be subject to the limitation. Number 5, certain retired uniformed service members, such as from the Army, Navy, Air Force, Marines, and Coast Guard, qualify for a new California gross income exclusion of up to $20,000 for retirement pay from the uniformed services if their federal AGI does not exceed certain limits. A similar exclusion also applies to annuity payments received by California taxpayers from a U.S. Department of Defense survivor benefit plan. No similar exclusion is available on the federal return. Our 6th Form 540 tip is that personal casualty losses claimed on a California return can be claimed by non-disaster victims, but only if the taxpayers itemize their deductions. They're also subject to the 10% of AGI and $100 per casualty limitations. On the federal return, only federal disaster victims can claim the loss, and those with qualified disaster losses can claim the loss even if they don't itemize and are not subject to the 10% of AGI limit. However, they are subject to a $500 per casualty limitation. Number 7, Section 529 account withdrawals made after July 4th, 2025 that are used to pay for a child's K-12 tuition or related expenses or for post-secondary credential programs will continue to be included in gross income on the California return and are subject to the 2.5% early withdrawal penalty, even though these amounts are excluded from gross income on the federal return. Number 8, California continues to allow a personal interest deduction for interest paid on up to $1 million in acquisition debt and $100,000 of home equity debt, even if not used to improve the home, whereas federal law limits the deduction to $750,000 and no deduction is allowed for interest paid on home equity loans. Number 9, the charitable contribution deduction cap remains at 50% on the California return and 60% on the federal return. And number 10, California continues to not conform to most of the TCJA business provisions, including 100% bonus depreciation, increased IRC Section 179 expenses, amortization of research expenses for foreign research, the increased business meal expense deduction limitations, and the increased deduction amounts for luxury autos. Spiedel's California Tax Letter is a monthly newsletter that will ensure both you and your clients are up to date with California tax law changes. You can get subscription details and download a sample issue at Spiedel.com under Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.